Do you know how much you are paying in income taxes nowadays? If you're like most retirees, you might be paying more than you need to. And the frustrating part of that is the IRS isn't going to tell you how to lower your tax bill. But that's where I come in. Welcome to the Retirement Fix, a podcast offering strategies for less stress and more success in your go-go retirement years. I'm John Gigliello, a certified financial planner with the Albany Financial Group, an enrolled agent licensed by the U.S. Treasury Department, and I'm here to be your guide to keeping more of your hard-earned money by making smart financial decisions in retirement. This podcast is for people nearing or in retirement who want to learn more about proactive tax planning, retirement income planning, Social Security timing, investment management, and asset protection. After a life-altering health issue at age 39, my personal journey in life became clear to me to share my knowledge of personal finance with people who are looking to make smart and responsible choices with their money. By the way, before I get into the meat of this episode, I want to take a minute to mention that we've changed the name of this podcast, formerly known as Invest in Knowledge. The name change to The Retirement Fix was made simply to better reflect the content that I've been sharing for the past 3 years and to help the appropriate audiences find me. You can still expect more of the same great tips on tax strategies, retirement planning, investment management, and other challenges faced by people wanting to craft a secure and comfortable retirement. In today's episode, I am going to address a big pain point for many retirees: taxes. Now, most of you just recently filed your 2024 tax returns, so the numbers may be fresh in your mind. Did you pay more than your fair share? Are you interested in learning ways to potentially save on your tax bill for this tax year and subsequent years? Then stay tuned because you're not going to want to miss this episode. Today we're breaking down how to avoid RMD tax penalties and keep more of your savings, the secret to reducing or eliminating Social Security taxes, how to pay 0% capital gains tax on your investments, ways to lower your Medicare premiums and avoid the Medicare surcharge trap that most retirees don't even realize is possible, estate planning tricks that ensure your heirs get more, not the government, and some pitfalls to consider with state income tax planning. So, if you're ready to keep more of your money and stop overpaying the IRS, let's dive in. The RMD trap, how to avoid a surprise tax bill. Well, let's start with something I call the RMD trap. This one catches so many retirees by surprise. But first, let's do a quick review on required minimum distributions. Now, starting at age 73, that's for those born between the years 1951 and 1959, and age 75, for those born 1960 or later, anyone with a traditional IRA must take annual withdrawals that are subject to ordinary income tax rates. Why? Well, remember that the earnings on the investments in your traditional IRA have been growing tax-deferred for possibly many years. And at some point, Uncle Sam is going to want his tax dollars. And there is a stiff penalty for missing those RMDs, 25% on the missed amount in addition to the income tax owed on the withdrawal. Ouch! The amount of your RMD is calculated by a simple formula. The IRS divides the total balance of your retirement account by your life expectancy factor as determined by IRS tables. While the IRS dictates how much you have to take, there are still ways to legally reduce your tax burden on the withdrawals. Let's look at the example of a fictional client named William, who retired at age 65 and had about $1 million in his traditional IRA. William thought, great, I'll just let it grow and I won't touch it until I have to. But that turned out to be a $12,000 mistake. Fast forward to age 73, and William received a letter from his advisor reminding him that he needed to take out an RMD of $40,000. And guess what? That $40,000 in additional income pushed him into a higher tax bracket, made 85% of his Social Security income taxable, and it even increased his Medicare premiums. All told, William ended up paying an extra $12,000 in taxes. A little planning ahead, however, might have saved him. Now, here are 3 strategies that may have helped William to reduce RMD taxes. Start withdrawing early. If William had the financial resources to strategically take smaller withdrawals in his 60s, he may have avoided increasing his tax bracket in any given year and therefore receiving a big tax bill later. If you're in a lower tax bracket before age 73, withdrawing early can reduce future RMDs. For example, if your RMD is projected to push you into the 32% tax bracket, withdrawing smaller amounts early, while still in the 22% bracket, can of course help. This strategy, however, has to align with your overall financial plan. Convert to a Roth IRA. Qualifying Roth IRAs have no RMDs and withdrawals are tax-free. By converting some of his traditional IRA assets to Roth IRA assets during lower income years, he could have saved money in the long run. Making Roth conversions is an excellent long-term strategy. For example, you may be able to convert $50,000 per year while staying in the 22% tax bracket instead of paying 32% plus in later years. Use a qualified charitable distribution, or QCD. If you're at age 70 and a half or older, you can donate up to $100,000 per year from your IRA tax-free. So, if you typically make annual donations to charitable organizations anyway, and you have available cash flow from other sources to sustain your lifestyle, you can send those contributions directly from your IRA. The money you donate counts towards your RMD, but does not count as income on your tax return. For example, if your RMD is $20,000 and you donate $15,000 using a QCD, you only pay taxes on the remaining $5,000. Now, I have several clients that take advantage of this important tax planning tool, saving thousands of dollars every year. The Social Security tax trap. How to keep more of your benefits. Did you know your Social Security benefits can be taxed? Many retirees don't realize this until it's too late. Let's break it down. Take fictional client Mary, for example, a retired nurse, and she receives $36,000 per year in Social Security and withdraws $40,000 from her IRA. Her total income in this simple example is $76,000. With that modest level of income, filing as a single individual, up to 85% of her Social Security becomes taxable, pushing her total tax bill up by thousands. First, you need to understand how Social Security is taxed. Social Security benefits become taxable based on what's called provisional income, which is your adjusted gross income, or AGI, plus non-taxable interest, such as municipal bond interest, plus 50% of your Social Security benefits. If your provisional income is $25,000 for single filers, or $32,000 married filing jointly, then up to 50% of your Social Security benefits are taxable. If your provisional income is $34,000 as a single or $44,000 married filing jointly, then as much as 85% of your Social Security may be subject to income tax. Now keep in mind that's not the tax rate, just the percentage of Social Security income that is subject to taxation, depending of course upon your tax bracket. Now here are 3 ways to possibly reduce the amount of tax taken from your benefits. First of all, delay Social Security claiming. For ages 67 through 70, for every year you delay collecting benefits, your benefit increases 8% per year. That's a pretty good rate of return on a low-risk asset. Avoiding Social Security early allows for lower taxable income years, which is perfect for Roth conversions. In the meantime, you may also be able to take advantage of early withdrawals from your other retirement accounts, essentially reducing your RMD requirements later on. Again, all of this is dependent on your own personal comprehensive financial plan. Use Roth IRA withdrawals. As I mentioned earlier, if you own a qualifying Roth IRA, withdrawals after 5 years are not taxable. So remember, if you converted a traditional IRA or other tax-qualified assets earlier, Roth withdrawals don't count towards taxable income. Keep taxable income below IRS thresholds. Right now, if you keep your provisional income under $32,000 for married or $25,000 for singles, your Social Security stays tax-free. For example, if you need $50,000 per year, you could take $30,000 from a taxable IRA and $20,000 from a Roth IRA to keep your provisional income lower. Now, of course, this could be a difficult hurdle to clear for higher net worth folks. The 0% capital gains tax loophole. Did you know that investment assets that are sold at a gain are taxed differently than W-2 income, pension income, IRA distributions, or Social Security income? Investment assets sold at a gain are taxed at the marginal tax brackets for long-term capital gains and qualified dividends, while pension income and the others mentioned are taxed at the marginal rates for ordinary income. Important because the top tax bracket for capital gains is currently 20%, while the top tax bracket for ordinary income is currently at 37%. Interestingly enough, this is how super-rich billionaires such as Warren Buffett avoid paying that top bracket of 37% on ordinary income. You see, most of his wealth has been accumulated not through ordinary income means, but through investment profits, dividends, and interest, which are taxed again at that lower capital gains rates. But now back to the more mundane. So here's a tax trick that very few retirees know about: how to pay the lowest possible tax rate of 0% on your investment gains. Let's look at how fictional client Linda cashed out $30,000 in stocks tax-free. Linda, a retired teacher, had some Apple and Tesla stock that had done quite well and gained more than $30,000 in value. She thought, if I sell these stocks, won't I get hit with a capital gains tax? Well, since she filed her taxes as single and her taxable income was less than $47,025, she paid 0% tax on her gains. Now, that's an extreme example, but more realistically, a retiree with $40,000 in total taxable income can sell stocks with $5,000 in gains tax-free. How to qualify for the 0% capital gains tax? Well, if your taxable income, including capital gains, is below, again, $47,025 for single filers or $94,050 for married filing jointly, in 2024 you pay 0% tax on long-term capital gains. You could sell investments strategically in low-income years, or you can offset gains with tax loss harvesting by selling losing investments. For example, if you have a $10,000 capital gain but a $6,000 capital loss, you would only owe tax on the $4,000. The Medicare surcharge trap: how to keep your premiums low. Here's a tax trap that catches many retirees. Medicare premium surcharges, known as the Income-Related Modified Adjustment Amount, or IRMA for short. If you're single and your income is over $106,000 or married and over $212,000, you will pay more for Medicare, sometimes thousands extra per year. The key is to keep your income under those thresholds. So here are a few ways you can avoid higher Medicare premiums. Withdraw from Roth IRAs. Again, Roth withdrawals don't count towards Medicare income. You could spread out big withdrawals over multiple years. Use QCDs, those qualified charitable distributions. Donations from your IRA keep taxable income lower. And delay large capital gains to avoid crossing those IRMA thresholds. Please note that there is a way to petition and possibly lower or eliminate these surcharges. Now, this topic will be the subject of an upcoming podcast, so please hit our subscribe button for future episodes. Estate and gift tax planning: how to leave more for your heirs. Want to leave more for your family and less to the IRS? Well, listen up. Consider gifting up to $19,000 per person per year, tax-free. A couple can gift $38,000 per person annually, reducing their taxable estate. So a common question I often get is, well, who pays taxes on the gift giving? Well, the simple answer is potentially no one. You see, the donee, or the person receiving the gift, does not pay income tax on the gift received. The donor, or the gift giver, will not owe taxes if they adhere to the limits mentioned earlier. If they gift higher than those amounts per person, technically they need to file a gift tax return to report the gift. Now, not to bore you to tears, but we all have what's called a unified tax credit that allows an individual to make transfers tax-free during their lifetime or at death through gifts or estate transfers. Of course, one can always choose to pay the gift tax in advance and not deplete their unified tax credit. This is definitely a complex topic, though, for another time. You can always leave a Roth IRA to your beneficiaries for a tax-free inheritance. Remember, there are certain qualifications that must be met before a Roth IRA can meet the tax-free status. And lastly, there are numerous ways to leave assets to heirs and protect these assets from potential estate taxes through the use of trusts. Now, just like the unified tax credit, trusts are another complex topic that will be the subject of a future podcast episode. Estate tax planning for retirees. If you are thinking about relocating as a retiree, consider which states have the highest and lowest tax rates. Also, it's important to research what states tax pensions from other states. For example, I have a client who lived and worked in New York. He was a retired police officer who was collecting his pension, and of course, which is not taxable in New York State. He moved to Connecticut due to his wife's job relocation and surprisingly found that when he filed his income tax returns for the following year, Connecticut was taxing his New York pension. Well, needless to say, he was not too happy about that. Now, the following states have no state income tax: Alaska, Florida, Nevada, South Dakota, Tennessee, Texas, Washington, Wyoming, and New Hampshire. The following states don't tax Social Security: Illinois, Pennsylvania, Hawaii, Texas, Florida, Nevada, and New York. All right, we've covered a lot today. RMD tax strategies, keeping Social Security tax-free, paying 0% capital gains tax, lowering Medicare premiums, and smart estate planning moves. One of the services I offer high net worth retirees is proactive tax planning. We review anticipated income from all sources each year and employ strategies to help clients make the most of their hard-earned money. If this sounds like something from which you could benefit, please reach out to us. You can find more about the services we offer at www.jgigliello.com. And don't forget, we always encourage you to take part in the financial planning process to pursue a confident financial future and, in turn, feel optimistic and proud about your accomplishments. If you've diligently saved over the years and have accumulated investment and retirement assets, and you understand that the success of your retirement is too important to be managing yourself, and you value experienced and professional guidance, please feel free to give us a call for a complimentary initial consultation. Knowing that I've provided education and a plan for my clients has allowed me to turn a personal health challenge into a gratifying journey. If you found this podcast helpful, please share this episode with others, and please don't forget to subscribe. If there's a financial planning topic you would like us to address on a future episode of The Retirement Fix, please reach out and let us know. Thanks so much for listening, and make it a great day. John Gigliello is a registered representative with, and securities are offered through LPL Financial, member FINRA, SIPC. Investment advice is offered through Private Advisor Group, a registered investment advisor. Private Advisor Group and Albany Financial Group are separate entities from LPL Financial. The opinions voiced in this material are for general information only and are not intended to provide specific advice or recommendations for any individual. Albany Financial Group and LPL Financial do not provide tax advice or services. Please consult your tax advisor regarding your specific situation. Traditional IRA account owners have considerations to make before performing a Roth IRA conversion. These primarily include income tax consequences on the converted amount in the year of conversion, withdrawal limitations from a Roth IRA, and income limitations for future contributions to a Roth IRA. In addition, if you are required to take a required minimum distribution, RMD, in the year you convert, you must do so before converting to a Roth IRA.